Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
I want to tell you guys my new website is finally up. It's rodkhleif.com. That's RODKHLEIF.com. And I've got a ton of videos on there that I know you'll enjoy. And if you haven't got my book yet, it's titled How to Create Lifetime Cash Flow Through Multifamily Properties. There's a direct download for the book on my website. You know, at some point, I'm going to be putting it on Amazon and charging for it, but you can get it for free right now via my website. Again, that's rodkhleif.com, KHLEIF.com. All right, let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. And I know you're going to get a ton of value from the gentleman we're interviewing today. His name is Brian Burke. He's got a $100 million portfolio, over 1,000 units, multifamily units. I'm very excited to hear about his story. And I know that his portfolio has literally been doubling every year, so he's doing something right. And he's the president and CEO of Praxis Capital, which is a real estate private equity fund. They do syndication. You know, I'm not going to do any more than that. I want to hear it from his words about his history. So, Brian, welcome to the show. I'm thrilled you're here.
Rod, thanks for having me.
Absolutely. I always like to go back and find out how people got started. I was listening to you getting interviewed on another show a while back, and I think you have an interesting story. So, if you don't mind, go back to when you first knew how to spell the word real estate.
Yeah, right. You know, I started at a pretty young age. I was 20 years old when I took an interest to real estate. It was 1989, and I made my first real estate investment, which was an $80,000 mobile home in a mobile home park that I bought for no money down by getting a finance company to finance a first loan, and I got the seller to carry back the down payment. Literally got into it for no money. And I rented that property out. I only owned it for a couple of years, but that was my introduction to real estate investing. And from that point on, I was just hooked. And, you know.
So you actually made money on an $80,000 mobile home?
Oh, no, don't get me wrong. I totally lost money on that deal.
I mean, I almost fell out of my chair when you quoted that price. I buy mobile homes for $3,000-$4,000. You know, I'm putting them in parks. $80,000, holy cow. Well, that's California, right? You're in Northern California, and you guys have some, dare I say, stupid prices up there sometimes, but holy cow, wow.
It's a whole different world up here. Yeah, pricing is just, it doesn't make any sense half the time, but you're right. I mean, you know, that's a lot of money for that type of a piece of real estate, if you'd even call it real estate, but you know, back then it was the only thing I could do to get into this business. And, you know, I rented it out and I resold it and actually made a few bucks on the resale, I guess. But, you know, over the course of the hold, if you add the whole thing up, it wasn't a winner. Sure. You know, I probably lost a couple $1,000 all said and done. But what it was for me was it was great experience. It was an introduction to, you know, a lot of what not to do, which I think in the beginning phase of everyone's real estate career, you get a lot of doses of the what not to do's. And I was very fortunate to get that right out of the gate. I think, you know, those who get a big success on their first deal get a bit of a sense of invincibility, which leads to potentially setting themselves up for bigger failures down the road.
I call them seminars, and I will tell you, my seminar was I had 800 houses when '08 hit, and I wasn't paying attention to cash flow, and the value of my real estate went up $17 million in '06 in 1 year, and so I thought I could do no wrong. So what you just said was painful to hear because you're right. It's exactly what happened to me.
Yeah, you did the same thing. You just added another zero at the end.
Yeah, but you know, and had I been focused on multifamily, I had apartment complexes that did just fine through '08. But when '08 hit, my single family portfolio got crushed. So, now anyway, I got that memo. So you started with a mobile home park. What was your next purchase after that?
My next one was actually my own principal residence, which, you know, that's an uneventful story.
Sure.
But then my next one after that was a house to flip. And I still had no money. And we bought the house from a defaulting homeowner by taking the property subject to their existing loan and bringing the defaulted loan current and then fixing up the house. And all of that was financed by borrowing off of credit cards. Yep. And it was a crazy way to get started in this business. And, but I had nothing to lose. I was young and a heck of a lot dumber. And
did the exact same thing. I bought houses for $18,000 on credit cards, but if the deal is good enough, you do what you have to do.
Yeah, that's exactly right. I think this one you'd add another zero. I think we paid somewhere around $200,000. But again, we assumed the first loan, so
right.
we didn't assume it. We just bought it subject to.
Right.
Yeah,
that's very common in flipping. So you started flipping. Did you have a full-time job then? I take it.
I did. I was in law enforcement, and it was a great job for me because when you're in the police business, I was working evenings and weekends, so I had the entire business week off essentially.
Oh, that's fantastic.
Monday through Friday, 8 to 3 were mine. I could do what I wanted during that period. So I got into flipping houses, and that's really how I started. I was a flipper. I never really believed in the market, so to speak. I never was a buy and hold or a long-term investor. All I did in the early years of my career was get in and get out as quickly as possible. And ultimately that ended up serving me well. I'm sure you'll realize why when you start to get through the chronology of what happened, over the course of the years I've been in this business. But it was never a long-term thing for me. Mm-hmm. So I started flipping and then increased the volume, from a couple houses a year to a point where at one point I'd done 2 or 3 dozen flips. And by the time I had done 2 or 3 dozen flips, I was making good money. I was starting to build a few houses, and I said, I think that my job is actually getting in the way, and it's costing me more money to go to work every day than I'm making.
That's a great problem to have. Those of you listening, that's called a quality problem.
It's a quality problem, and it's also a signal that, okay, it's time to make a change. And some people, they want to quit their job really early on. And, I waited until I realized that the job was more of an obstacle than anything else.
Let me just interject one thing, guys. Those of you that get to the point he got to, it's not always, even when you're at that place, it's not always a great idea to quit the job, because if you're going to be utilizing income to qualify for other real estate, you need that income. So keep that in mind when you're making that determination.
Yeah, no, that's a great point. And, I was financing everything I was doing with private money capital, which didn't rely on the income. But, that's not always a great idea either. So that is a great point that the listeners should absolutely pay attention to. And, that decision to leave is not an easy decision to make, and nor is it always an obvious one. And it was one I struggled with quite a bit. But what I did, and this is actually, that decision launched my career, because when I left, I went in and I put in my 2 weeks notice at the station. And I told all the guys, I said, guys, I'm leaving. I put in my 2 weeks notice. I'm going full time in this real estate gig. And here's what I'm going to do. I reserved the room at the community center. I want all you guys to come, and I'm going to talk about what I'm doing with real estate.
Oh, love it. Your first syndication meeting.
That's exactly what it was. And we sat down in that room, and I did my dog and pony show about what I'd done in real estate and what I was planning to do in real estate. And as I like to say, I walked out of that room with $500,000 in commitments and 28 investors with guns.
And you know what? I was just about to interject something that you want to be very, very careful that you have your ducks in a row before you borrow money from friends or family. But in your case, they were friends with guns, even more risky.
That's right. Oh, I literally had my life on the line. This is one of those cases where, failure is not an option.
That's awesome. Oh, that's a funny story. So what next? What'd you do?
So I took that money that I'd gotten from all of my friends and soon to be former coworkers, and I put it into a blind pool that was done through our attorney drafted the documents for an LLC that was a Reg D offering essentially.
What year was this? Brian?
This would have been 2001.
Okay.
So with that money, I was out buying foreclosed real estate, and I was literally on the courthouse steps making bids
and still
at
in
foreclosure
single family
auctions.
then. You're still flipping.
Still
You
single
use
family.
that money to flip houses. Got it. Okay.
That's right. Yeah, I used it to flip houses, and I was doing a couple dozen houses a year at that point. And then as time progressed, I started getting into other things. So, I developed a self-storage facility. I developed
awesome.
a lakefront resort.
Wow.
Which was not a good experience. I don't recommend it. I did a lot of residential development, built a lot of houses, and just kind of grew the business into a bunch of different things. But one thing I did, which was a catalyst to my future growth, was I did a 1031 exchange on a few houses that along the way of this flipping, I had collected a couple of them in my personal portfolio as rentals, and the market was going up. So I did a 1031 exchange on a few of those houses, and I went into a small apartment building. It was 16 units in California, which, may not be much in some states, but in California, that's a lot.
Sure. No, that's a high price tag. So you did a 1031 exchange, and those of you listening, what that is it's called a tax deferred like-kind exchange. I've done numerous of them. And basically what you do is you take the profits from whatever you're selling. And in his case, it doesn't have to be one property, and it doesn't have to be the same type of property. It just has to be an investment property, and you use that money to invest in like property. Invest other investment property. And so and that defers the tax, so you don't have a taxable gain. It's an awesome tool to use as you're trading up, which is exactly what he did. You traded up. So you bought this 16 unit. How'd that go?
It went great. In fact, I still own it to this day.
Wow.
It was my first multifamily investment, and then I started doing more of that.
What year was that, if I might ask, if you remember?
That was 2002.
Okay, all right. So you're way before the crash. I'm anxious to hear how you weathered that storm. But let's finish with your biography first.
Yeah, absolutely. So when I bought that, it was 2002. That was my first entrance to multifamily, and come about 2003, 2004, still in the flipping business, but I was starting to get a feeling, a gut feel. You know how sometimes, Rod, when you just have a feeling that something's going to happen or something's going to change. And I was getting that feeling come about 2004, and real estate prices in California just seemed to make no sense to me. I'd go to the investment club meetings, and people would talk about how, I've got to buy a rental house and it's $500,000 and it rents for $1,500 a month. And, and I'm doing the math in my head and thinking, oh my gosh, what's attractive about that? So, you could tell that there was beginning to be a euphoria over real estate. So I started scaling back my house flipping business, and went from doing a couple dozen houses a year down to about 3 or 4. And the only ones I would buy were ones that, if the bottom fell out, I could probably still get rid of it before it fell far enough. All right,
and I have to stop you there because, guys, we are nearing that place now, okay? At some point, we're getting near a top, and real estate goes in cycles. I've been through 3 of them, and it's going to happen again. So if you're out there flipping houses, please pay attention to what he just said. He focused on houses that he knew he could get out of quickly and easily. Do not be doing multi or $1 million flips right now, because when the music stops, it stops very quickly, and you do not want to be caught holding the bag. And that actually brings me to another question. I guess I could. Well, let me ask it now. When you're out there right now buying your multifamily properties, obviously much larger properties, what sort of debt are you putting on? Are you doing what sort of balloons are you going with? I mean, what's comfortable for you and your team?
Well, the only balloons I really like are hot air balloons.
Right.
I'm not really that into balloon mortgages. So on a smaller level, in my personal rental portfolio, everything I own is financed with 15-year fully amortizing debt.
Fantastic.
And so I know that that's my retirement plan, right? I know that by the time I'm old enough to retire, all of my rental properties will be fully paid for, and I can just live off the rents if that's the only thing I have.
I want to put an exclamation mark by that one too, guys. That is a fantastic strategy. If you're buying property well enough that you can put 15-year debt on it, it's going to be paid off when you really need the cash flow. Brilliant. Okay, but the larger stuff that you're syndicating now, I mean, obviously most of the non-recourse money, there's going to be, you have to have a liquidation event at some point because of a balloon. So
you do, and so I'm looking for 7 to 10 year debt, and really my strategy now is to acquire with a 7 to 10 year floating rate loan that we can use as an interim financing vehicle and refinance after we've added value to the property.
Love it. And let me tell you why I love it. And guys, this is why I asked the question. Because when the market contracts, and who knows when it's going to happen, it could happen in a year, it could happen in several years, but when it happens, cap rates are going to expand. And when cap rates expand, values go down. And if you have to refinance, even on a property that's cash flowing extremely well, and you're in 5-year debt, so let's say the crash happens in 3.5 years, and it's at the bottom in 5 years, but you have to refinance because that's the debt you took on, you're in big trouble. I mean, you could have a great cash flowing property, but the value's not there because the cap rates have gone up. So, when you're saying 7 to 10 years, that's safe, and that's why I asked the question. So sorry about the segue there, but I really wanted to see how you did it, and I'm impressed that you're doing it that way. So back to your 16 unit. What'd you do after that?
After that, as I was scaling back my house flipping business and realizing that there was really no excuse to own real estate in California, I started looking out of state, and I started looking at. I bought an 11-unit building in all places, if you'll believe this, in Buffalo, New York.
Wow.
And the reason that I did that is I'd studied that market, and I found, that market never moved. It never really went up. It never really went down.
Very stable.
But it would cash flow like a dream. So knowing that we were in this bubble territory, I decided to go and buy something somewhere where if the bottom fell out of the world, my value probably wouldn't go down, and my rents probably wouldn't go down because they never really went up. So. As history has shown, I was right. So I bought that
awesome.
building.
How'd you manage that property? Is that small of a property that thousands of miles away? How did you coordinate that management?
I did it by referral.
Okay.
I talked to a lot of people and got referrals to local property managers and interviewed several local property managers. Of course, I flew out there. We didn't buy this online without looking at it.
Right.
We actually went out there. We looked at a lot of real estate. We settled on a great building in the absolute best neighborhood in town. So it was a great location, and it was just something that we knew from a location perspective, from a macro level. It was the risk was taken out of it for the most part, as it compared to other markets where I felt there was a high degree of risk. Okay. And when you're in the business of buying real estate, there can be a disease I call it always be buying. And
right.
You have to really stay away from that disease, although it's difficult. So, when my theory was, okay, if I'm going to be buying, I'm going to buy something somewhere that's going to work given what I see happening in the world at that particular time. And I always like to say that realtors will tell you that the keys to real estate is location, location, location. And
right.
I disagree. I say that the keys to real estate is location, timing, and strategy. And what that means is it means employing the right strategy in the right location at the right time. And I felt that at that time, a strategy of buying income real estate in a market that didn't have a lot of market forces and movement was the right strategy at that time. No. I wouldn't do it today. Today I have a different philosophy on what the right strategy is and what location to employ that in.
Well, I can't let that go by. Let's hear what it is.
Well, real estate markets in my view, they don't there's several elements to real estate markets. You have locations, and you have product types, and you have strategies within those product types. And none of those elements track in parallel to one another. They're always in a different phase. So I believe that it's smart to have a lot of different angles in executing your real estate business model. So for me,
I didn't get any of that. So you're gonna have to dumb it way down for me.
I'm gonna do that. I'll tell you how I do it.
Okay.
So for me, I have 3 platforms that I focus on. Okay. One is single family, and within single family, we buy, fix and sell, and buy and hold.
You're still doing that today?
Yeah, believe it or not.
Wow. Okay, that surprises me. Okay.
Well, and I'll get into why in a minute.
Okay.
So the other strategy is multifamily.
Right.
And then the other strategy is an opportunistic platform. And so I'll kind of go into each of these so you can kind of see what I mean and what the differences are and how the listeners out there can use this in your day-to-day investment decisions. Okay. So so knowing that these market forces don't track in parallel to one another means that the cycles of these various components of real estate are always out of phase with one another. And the best example I can provide for that is if you look at 2009, the period of 2009 through 2000, call it maybe early 2011, it was a really bad time for those folks who had owned single family that acquired them earlier pre-crash. I don't have to tell you that. I'm preaching to the choir.
No, you do not have to tell me that. That was a $50 million seminar for Mr. Cleef here. But
yeah, exactly.
I'm reliving that pain right now.
Sorry about that.
That's okay.
On the other hand, it was a really bad time to acquire multifamily assets because from that 2009 to 11 period, there were massive job losses in the economy. Vacancy rates were increasing. Default rates on rents, so collection losses were going up. It was just a really tough time in multifamily real estate. Yet foreclosures were absolutely through the roof. And prices were, real estate was trading at a significant discount. In some cases, I was seeing some properties. In fact, we were buying properties in 2009 and 2010 for prices that were less, get this, I researched this, less than that same property traded for in the early 1980s. Okay. We literally turned the clock back 30 years.
Let me please add a little aside on this. And I interviewed some guys in St. Louis that started in 2009 that literally now have 3,000 units, and they capitalized on this by their first couple of deals were directly financed by the banks that had taken these properties back as REO properties. But guys, there's a clue there. There's going to be an incredible opportunity again when this market cycles. So, this is, and I tell people, because I take free calls from my listeners, and so many of them, are frustrated. Like you just said, don't be in a hurry to spend your money. Take this opportunity to learn this business and be poised and ready to rock when the market corrects. And you may find deals along the way, but if you don't, it's okay. But wow, unbelievable deals. So you were buying then, and what markets were you buying in when in 2009 through 11?
We were buying single family in the San Francisco Bay Area and Sacramento regions in Northern California, and I literally I told you I wound down my house flipping business in about 2004.
You weren't talking about multifamily in this. You were talking about single family. Oh, okay.
Single family. So what we were doing was I wound down the single family flipping business in 2004. Kind of brought it down to about 3 or 4 houses a year, but in 2008 started ramping it back up again because of the reset in pricing.
Right.
In 2009 we just went full speed ahead. We went from doing 4 or 5 houses a year literally to over 100 houses a year immediately. We just pressed the go button.
Fantastic.
So in the San Francisco Bay Area, we were buying, fixing up, and reselling over 100 houses a year from 2009 to about 13. But that was only the cycle would allow for that. Yet at that exact moment, it was not a great time to be in multifamily. I had a multifamily property that I'd purchased in 2008, and it was suffering. So what you're
saying is you didn't have a lot of multifamily through 2008.
Correct. Yeah, I really well. I had my 16 unit in California, which was doing just fine. I had my 11 unit in Buffalo, New York, which was doing fine because the market there doesn't ever move. In fact, it actually went up in value during that period of time, which was kind of crazy to think about. But I decided to push the go button on multifamily in 2008, and I was about 2 years too early. I wish I hadn't. I bought a 60 unit property in Texas. And,
you mean you bought at the top, basically?
I bought, well, it was not really. So I thought I was a genius because I bought the property for half of what the guy before me paid.
Oh, I see.
So his value fell dramatically. And I thought, okay, great. I'm coming in after the crash. It's 2008. The big drop from 06 to 08's already happened. So I'm good to go. And I bought that property. And, it needed a lot of work. So I put money into it. We fixed it up. We got the occupancy up to 99%, and it stayed there for like a week. Because a week after that is when Lehman Brothers fell and, the whole thing, that
That's
it was
when
late
the big
2008.
Yeah.
It was the big crash. But this wasn't the real estate crash. This was the economic crash.
Right.
And so the economic crash is what caused all the job losses. That's what caused people to stop paying rent. I used to joke that, half your apartments are empty and the other half aren't paying.
Yeah. Well, my experience wasn't that bad. In fact, my multifamily, certainly it contracted, but it really did just fine through the crash. And maybe it was more area specific, but we had to do some creative stuff to keep keep units occupied for sure, and we had to work with people, no question. But we made it. My multifamily portfolio did just fine through that period. But I know it. There are certainly some area dynamics to that, but what you did is brilliant by taking advantage of the downturn in single-family homes because there were fantastic opportunities. I was so shell-shocked because of what I was going through that I wasn't in any place emotionally to capitalize on that opportunity. But that's very impressive that you did. So when did you? So you regret doing that Texas deal? How did that deal end up, by the way?
Well, what happened was that when the income fell about 6 or 8 months after I bought it, it went from being fully occupied to really horrible, and it stayed that way for about 4.5 years. The income fell to a level where the property generated enough income to pay the operating expenses, but left no money for debt service.
Wow!
So what ended up happening was I serviced the debt on that property $15,000 a month out of my own pocket for 3.5 years. Because there was no way my investors were going to lose money. I'd never lost investor principal before, and I wasn't about to start then. So,
wow, that's a horrible story. Now, let me ask you this. Were you self-managing, or did you have a management company?
No, I had a management company, and they were doing everything they could to get the to get the income and occupancy up, and they were doing a great job, but they were just up against so many headwinds, and it was just really
Texas,
bad.
Just like Florida got creamed real bad. So rough experience, but you kept your investors whole. That's very admirable. So when did you really get busy again?
We really got busy again in 2011. So we were really busy buying single family, from that 08 period.
Yeah,
but what we realized was I thought, this is a limited lifespan opportunity. This massive flipping business is going to last 3 or 4 years, and then that's it. It's over. What's next? So I turned my focus back to multifamily, which is an odd thing to do given the fact that I have this pain from this property that's burning a hole in my pocket at the tune of $15,000 a month all the while. But I still knew that when the economy turned around, the multifamily business was not only a great model, but because of all of that bloodbath, it was also poised for a big upswing.
Some opportunities, you bet.
And some opportunities. So about 2011 is when I pressed the go button again on multifamily and started buying and still focusing on Texas. Bought 54, I think it was, unit property in Austin, and then bought 140. Just a fabulous market, just an incredible market. I mean, we bought that deal for $800,000, put $800 into it to fix it up, and sold it for 2.6 in 21 months.
Wow!
It was just a great deal. And then then we bought 136 units in Houston, 140 units, 276 units, and it's just. it was just one after the other.
So let me ask you this: is your strategy to buy and sell, or or are you buying to ultimately hold?
Neither.
Okay.
And you'd think that would be an either or question, but people ask me this all the time, and I say I'm not a buy and flip investor, and I'm not a buy and hold investor. I am a buy and watch investor.
Okay.
So what I do is I buy the real estate, I make my improvements, I add value, I bring up the rents, raise the income, which raises the property value, and then I watch for the right time to exit. Now, we talked a minute ago about how long of a balloon we have on the loans and 7 to 10 year financing and so forth. What I underwrite everything to a 10-year hold, and when I show my investors a pro forma, it's a 10-year hold on that pro forma.
Okay.
But the reality is, and the reason that I do that is I know that at some period in our future there is going to be an adverse cycle.
Sure.
I don't know when it's going to happen. That's
Right.
the one thing I can't predict with any level of certainty
Nobody
right
can.
now.
Right.
Nobody can. So if I have a 10-year lifespan on my projection, number one, and number two, I do it with very conservative assumptions as to occupancy, credit loss, concessions, and all those components of economic vacancy that make up for the difference between what you're charging in rent and what you're actually getting. If I stay very conservative in that regard and use a decompressing cap rate, which means a higher cap rate on my exit than you would use today.
Well,
if
sure.
I can get a deal to pass all of those tests and a 10-year hold, I know two things can happen. One, I can perform well when I sell it in 10 years. And two, if there's an adverse cycle, I can survive through that adverse cycle to get to that 10-year period to deliver that performance. Because if you can't get there, then the whole thing is moot anyway.
Okay.
So by using those two,
I'm sorry. I talk to people that their liquidation event is a refinance, and they like to buy and that's really my strategy as well. I like to buy properties. I like to call myself a buyer, not a seller. And I've interviewed some really big players on the show. My first interview actually was a guy named Al Barris that owns McKinley with 35,000 units, and that's his quote: "I'm a buyer, not a seller." Do you ever regret any of these sales?
Never.
No?
I can
Okay.
never regret taking money off the table and
All
taking
right.
profits.
Yeah, that's a
I
good
believe
answer.
you can't go poor making money.
No, you're right.
And if you can pull some off the table and make some
Okay.
money and lock in those profits, I think you're winning the game.
Okay. So you keep your personal portfolio for that long-term cash flow at the 15-year debt, and you treat your syndications like you just described, which is great. I mean, and that's and to a lot of investors, that's very, very appealing to know that there's an exit and that they're going to be made whole, and get those big long-term internal rates of return. Let's shift gears for a second. What suggestions would you have for someone wanting to start out in this business? What tips would you give them? Somebody that maybe has done some flipping, has maybe even just done wholesaling and flipping, and or maybe has a couple of single-family homes, but they want to get into multifamily. They see it as a long-term cash flow. What suggestions would you have?
Well, I think my first suggestion would be that they have to be prepared that this is going to be hard, and that you have to work hard and you have to weather storms, and it's not easy. And
Okay.
if you think that you're going to be an overnight success and you're not prepared to do the hard work and prepared to weather storms and make difficult decisions from time to time, then do yourself a favor and do your investors a favor and don't even start. Be ready, because this business is not easy. The only time that this business is easy is in the delivery of the speech from the guy that's selling a course on real estate. Other than that, this business is just not easy. And you have to be ready for those speed bumps.
Do you enjoy the business, Brian?
I love it.
Okay. Because I got to tell you, I want to come back at you with that last statement, because frankly, in my opinion, if you love something, work is play. And I love real estate. I live, eat, breathe, and sleep real estate. And that's why I tell you guys listening, And I've taken calls from people, and they're like, I want to get into multifamily real estate, but I really want to start this other business. And I say, what are you going to love? And they say, well, I really love the other business. I say, well, forget multifamily real estate. Go do the other business. I want to kind of caveat what you just said. Yes, it's hard. Everything's hard. Anything you do when you start a business is hard. But if you love it, you'll get through it. As long as you have goals and you have compelling whys for those goals and you know what your ultimate outcome is and what you want, sure, are you going to have setbacks? Are you going to hit walls? But if you're loving what you're doing, you're going to go around the wall, over the wall, or through the wall to get to your ultimate outcome. So I just want to throw that in, Brian, because I don't want to discourage anybody listening from this business because it's a fantastic business. And again, you have to love it. Would you agree with me?
I would agree with you. You have to have a passion for it because it's hard. You have to have a passion for it to make that, to make it through that. And if you don't have that passion for it and you don't think it's going to be hard, it's gonna crush you.
No question. Dabblers get crushed, and no question. Now let me ask you this. I want to go back to something else you mentioned. Do you still use outside management, or do you self-manage now?
No, at the moment I still use outside management, although we're looking at doing some vertical integration as we expand our platform.
Yeah, I tell you, all the big players that I've interviewed self-manage. So I'm that's why I asked the question. I guess my experience has been, and I don't know, maybe you've been real lucky up to this point, but you typically end up having to manage the management company anyway. Have you had good experiences in your management experience?
We've had great experience in it, and that's by design. We were very careful in the selection of our management partners. But I agree with what you said, and what you said is also true about the large players. We're right at the cusp of making that transition now in our future portfolio as it continues to grow. But when you're first starting out, a lot of people, I think, make the mistake of self-managing too early, especially out-of-state investors. It's kind of an old joke, in the brokerage community, it's especially like in Texas, you got, it's the California self-managing buyer again. That's the guy who's in trouble, and it's opportunity for the buyers.
Right. Agree completely. And those of you that haven't managed multifamily, definitely hire a management company initially until you understand the business, no question. And I agree with you about what you just said. People self-manage too soon. Absolutely agree. Let me ask you this. Did you have any mentors in your path to success?
Gosh, if I did, my path to success would have been much more rapid. I've been doing this for 25 years, Rod. And I mean, our business really started to grow within the last 5 or 6 years. And, and only now is it to the point where it really just feeds on itself. Had I had good, solid mentorship, I might have been much more successful much earlier on in my career. That said, I think everything in life happens for a reason. And had I had too much success and too much growth earlier than I did, it would have been a lot of pre-crash growth, which would have really hurt me when the crash came.
Oh, no, I totally agree. Absolutely. I totally agree. We talked about that. Let me ask you this. Do you have a team? Tell me about your team.
Yeah, I do have a team. In fact, I have a great team. We've, our company grew to 25 employees when we were at the peak of our house flipping operation, which, we obviously didn't need to be that large now for what we do. But I do have a senior vice president of investor relations. His job is strictly to interface with investors and bring in new investors. And then I have some accounting staff. On the house flipping side, that's still an active business. We have acquisitions and dispositions directors and and that type of thing, and research analysts. On the multifamily side, I have a research analyst that helps with some of the financial breakdown. So we definitely have a team.
Your pro formas and your financial information for prospective investors and the like. Is that what that person does?
I actually I take that role on personally because it's so personal to me. What I tell the investors that we're going to do, we always have to outperform those numbers, and therefore I have to architect that myself. But what my analysts will do is they'll take the historical income from a property and break it down, analyze it, and put it in the format that we use, and have all that information staged up ready for me that makes me more efficient.
What software do you use to financially analyze a deal?
I wrote it myself.
Oh, you did?
I use my own. I use my own software that I wrote myself.
That's awesome. Now let me ask you this. Let's tell me. I want you to tell me share both a war story and a victory story. And maybe you already told me the victory story, but tell me about a war story where you really got your nose bloodied and the takeaway.
I probably told you more of the war story than the victory story. My war story is that property that I bought in Texas and having to service that debt for 3.5 years.
Yep.
That was a real war story.
Yeah, that's painful.
think the victory side of that, though, is, we actually sold that deal and the investors made a profit and I got back every dollar that I injected. So maybe that's kind of a victory story in and of itself. But I think my biggest victory story is probably my single family rental play. Right. In 2013, we started buying single family homes as rentals. We spent about $8 million, bought a portfolio that at the one by one, bought houses that at the time were worth about $15 million, and we're selling those houses now. By the time we're fully exited, we'll probably be out of that deal for around $30 to $35 million, which is a huge victory.
Wow.
Considering that people thought real estate was toxic. When we were buying those properties, people thought we were crazy. They told us we were nuts and we were wrong. And it looked like we were right. And I consider that to be a massive victory.
No, that's fantastic. Good for you. So, let's shift gears for a second. What books do you love? Give me your top 3 books, business related or personal growth related. Yeah.
Gosh, who has time for books?
No?
It's funny. I haven't read a lot of books lately. I used to read a lot. Of course, my favorite used to be, The Art of the Deal was a great book, and everybody loves Trump, Rich Dad. Yeah, and Rich Dad, Poor Dad. Everybody talks about that one. I loved that book. That was a big, big push for me to really think outside of the box. That did a lot for me. Right now, the book I'm reading right now is called The Singlefamily Office, written by Richard Wilson.
I know it. Yeah, I went to one of his meetings, actually, one of his family office guys are when you've got hundreds of millions of dollars or $1 billion, you set up a family office, you've got financial advisors, and I'd actually gone to one of those for my own syndications. I'm sure that's why you're interested. But that's these people, they have a lot of money to spend. So
it is, yeah. I've been on expert panels at a number of conferences for family offices and awesome. Done a lot of speaking for them. And they family offices are one of our investor categories. We work with high net worth individuals and family offices. So I wanted to understand, what does a family office go through, and what challenges do they have? And so it's an interesting book to kind of see it from the other side.
Yeah, I have it. It is good. Let's leave my listeners with one last little golden nugget. Guys that are thinking about getting into this business, what's one last little tip you'd give them?
The financial collapse in 2009, it taught me a lot of lessons. I learned a lot about underwriting income real estate. Mm-hmm. To stress it to the worst case scenario and survive market cycles. So I think my best advice is always underwrite to survive, because if you don't survive, you can't perform. And to always know that different elements or different ways of investing in real estate are out there, and their success and failure moves in cycles. But from one asset class to another, the cycles don't always track together. So if you're in and gain experience in different aspects of real estate investing, you can always stay successful, because you can always employ the strategy that's working in the location you're working in at the time that you're working in it.
Oh, that's great advice. Great advice, Brian. Well, listen, you've added a ton of value. How do people get a hold of you, Brian?
The best way is probably through our website, which is praxcap.com. It's P as in Paul, RAXCAP as in Paul.com. There's information about what we're doing on the website.
Awesome. Fantastic. Brian, thank you so much for your valuable time. Happy New Year and tons of success in everything you do.
I appreciate it, Rod. Thanks very much.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.